Well, welcome back, everybody, to another episode of Finance Uncut, coming to you on the weekend as we've got some breaking silver news. And in breaking news, silver prices extended losses below $24 per troy ounce from a 7-week high of $24.60 hit on October 25th. Amid a tick-up in US Treasury yields as investors brace for a hawkish shift in the Federal Reserve monetary policy. The Federal Reserve's monetary policy decision on November 3rd could mark the beginning of the unwinding of its $120 billion monthly bond purchases. Elsewhere, the European Central Bank pledged to continue the pandemic-era asset purchases program until at least March 2022 and left its rate hike outlook unchanged, even as the Eurozone economy is faced with a multi-year high inflation rates. On a weekly basis, the white metal is on track to erase 1.8%, snapping a 5-week rally. And when we have a look at the silver chart, we did get above that $24 mark, and that was actually some good signs. I actually did buy some more silver when it did fall down into the $22 range. I accumulated a little bit more. In fact, I bought some gold as well. Actually bought more gold than silver this time, only because of my structure of my portfolio. I'm very heavily invested in silver, and my silver portfolio, my physical precious metals, is up 40% from when I bought it in March last year. So I'm very happy with my silver performance at the moment. Obviously, we want to see it do much better, and I think we will. We've just got to be a little bit patient. So let's cut to a clip now with David Smith, who sums up nicely why I'm investing in gold and silver right now.
Why are precious metals, why do they have more firepower than, for example, stocks or bonds?
Well, for one thing, silver arguably is the most undervalued metal on the planet. I mean, you look at the chart from 1980 and today, and it's the only metal that has not exceeded its nominal high since that time, which is just crazy because it's arguably one of the two most critical metals in the metal space. Copper being the other one, but that has a different metric as well too. But when iron is up 700 or 800% in price from its 1980 high, and the others are up 300 or 400%, and silver is at 50% of its 1980 and 2011 high, it really doesn't make sense, especially when it's literally the critical metal for modern day living in just about anything you can imagine.
I really love this chart from Tavi. If gold and silver miners were considered a sector, it would be the only part of the economy today that generates higher free cash flow yield than inflation. And seriously, you want to know why I'm invested in this sector, in this crazy economic world, this distorted interventionist markets that we have, why I want something that is real, something that is undervalued, something that actually produces free cash flow. Here it is for you. Now let's have a look at Janet Yellen. In February, Yellen downplays inflation fears amid Biden's $1.9 trillion stimulus bill. And in March, Yellen says US inflation risks remain small and manageable. And then in May, Yellen expects high inflation rates to be temporary. And then in June, Yellen says inflation could reach 3% this year as recovery. And then, October, Yellen sees inflation staying higher for the next several months. And now she says that the $1.75 trillion framework is transformative and will actually help inflation go down. These guys have completely lost their minds. Folks, tell me, are they idiots? Are they dumb? Are they stupid? Or are they actually sinister? I don't know. You guys tell me, because I don't know what economic textbook they ever picked up that thinks, hey, we can have all these restrictions on the economy and and reduce supply of goods while at the same time increasing new currency units into the economy. I mean, and that's supposed to make inflation go down? I don't know. Have I lost it? Am I the one that's going mad? You tell me. So this from Peter Bookvar. The S&P Core Logic says that its home price index was up 20% year on year in August, as housing makes up 30% of CPI and 40% of the core. If this metric was included instead of imputed rents, CPI would be up more than 10% year on year. And we could say the same thing here in Australia. So our CPI came in at just over 3.01%, and Tarek here nails it. Like I said, quarter 3 CPI has drastically understated the impact of rising rents. According to the ABS, that's the Australian Bureau of Statistics, rents rose by just 0.18% in the third quarter, or 0.36% year on year. Meanwhile, Core Logic recorded it at 8.9% year on year. Imagine what the CPI would look like if it accurately measured this. And I can't remember how much rents actually make up the CPI here in Australia, but I know it's a significant chunk of the CPI measurement. So whether it's the US or Australia, the government are clearly understating the real CPI increases. So, but I believe people are starting to wake up and aren't believing that it's so-called transitory in the sense that central banks have been pushing. So with yields spiking, we have a look at the cash rate futures update. And in May 2022, we've got the first rate hike priced in. And that's potentially around the election. I presume ScoMo will like to probably go before that. Although some prominent people are now coming out saying that the RBA need to raise rates before the end of the year. So maybe that might happen a little earlier than we thought. However, if we have a look at this, we have a second rate hike priced in for August, a third in October, and a fourth in November. So 4 rate hikes next year. Remember the RBA said, what, 2024 would start raising rates. So 4 rate hikes priced in for next year, and then a 5th in February 2023. So it'll be very interesting to see what the RBA does moving forward. My prediction is that they will raise rates, that central banks around the world actually will start to raise rates. But they're not going to be able to raise rates too much. I don't think they want asset prices crashing. Or maybe they do. Maybe this is part of the whole Great Reset program, and how you'll own nothing and you'll be happy is just jack up rates and everyone with debt just can't pay it, and will they come in and just take it? I've heard that scenario. Maybe that is a play. I don't know. Nothing makes sense in financial markets and in the economy at the moment. So who knows? But you know, they've been wanting to prop up asset prices. In Australia, we are pretty much a property-driven economy, digging stuff out of the ground and shipping overseas. That's our economy. That's pretty much it. So, you know, when we've got banks that are leveraged up to the real estate market at about 65% of balance sheet, more than any other country around the world. Our banks are heavily leveraged to the residential property sector. And in our business, we are seeing debt increasing for home buyers and homeowners. Homeowners that have got equity feel that they're richer, and so they take cash out, that equity, in more debt to spend, and usually to consume, not to increase assets or increase income or cash flow. So this is going to be very interesting. There's some prominent property bulls. Christopher Joy and Stephen Kokalis, who was an advisor to the former Labor government, have been property bulls, and interest rates staying low or interest rates being cut for some time. That's been their position. Well, both of them all of a sudden last week started coming out saying, interest rates are rising, homeowners, you might be in trouble. I think Christopher Joy wrote an article in the Fin Review saying we could see a 20% crash in property. Now, I know others predicted that last year. And to be fair, even the banks themselves came out and said we're going to have a property crash. No one saw, the mortgage deferral payments and all the grants given to homeowners and would-be home builders, as well as taking funds out of their superannuation, out of their retirement accounts. So there was a lot of government intervention right across the world. And so what we've seen is supply drive up and a demand for property, especially people wanting to get out of the cities. We're seeing that a lot. But so this is going to be very interesting to see what happens. And this could create a bit of a liquidity event, which, as Brent Johnson talks about with his dollar milkshake theory, we could see a sell-off in assets. We could see a big run to the US dollar, and the US dollar could turn into a bubble, which is great for me because I've got that trade on. Yes, heavily invested in commodities, gold, silver miners, and commodity miners and whatnot. So I'm on the inflation trade, folks. I haven't jumped off the inflation bandwagon, but I could see this play. This trade playing out, and the US dollar spiking, even becoming a bubble. Then I will convert those US dollars into Aussie dollars and then buy these super cheap, they're already super cheap gold and silver miners as it is, but we could see them actually beaten down a little bit more if this happens and we do see a sell-off. Initially, we'll see them beaten down in a sell-off, but I believe eventually all this surplus cash will find its way into safe haven assets and value assets. And this is where I think gold and silver stands to do extremely well. And here's that article that I was talking about from Christopher Joy, who said house prices could fall as much as 20% after rate increases. And my buddy Tarek Brooker, who's a financial journalist, says Chris Joy has predicted that a 1% rise in the cash rate could cause housing prices to fall 15 to 25%. Meanwhile, RBA research shows a 1% rise may result in a 33% fall. It's certainly a fascinating development given his reputation for bullishness. And that's what I said. Christopher Joy and Stephen Koukoulas have been the biggest property bulls in the last 2 decades, I would suggest. And for my American friends, the Case-Shiller Home Price Index is looking more bubbly now than it did back in 2007. And I've shared on this channel, as a US property investor, I've been selling my US properties this year into this crazy bull market. People are paying all around the world, here in Australia as well, paying ridiculous amounts above any sort of market value for property. So, yeah, thank you very much. Buy cheap, sell high. That's always been my mantra, and that's why I love gold and silver at the moment. They are the most undervalued asset out of any asset class on the planet at the moment, and gold and silver miners are dirt cheap. So, yeah, then they're not running up like everything else. That's cool. I don't care. I'm patient. I buy things that are cheap, and I sit and wait, and things play out. And when things become a bubble, I sell. Pretty simple. That philosophy has worked well for me. And folks, trust me, I've made every mistake under the sun. I have lost a lot of capital by chasing things and using margin debt, and I've never touched CFDs, but I've made every mistake that you can think of. My business partner likes to remind me, Steve, think of it as a very expensive university degree. And it was making those mistakes and losing a lot of capital was the best learning experience for me. The hardest learning experience, I hated it. I wish I could have learned it without having to make those mistakes. But it's pretty simple for me when I buy value businesses or value assets, things that are undervalued, that are unloved. However, the macro trends have got tailwinds, so they might be undervalued, but there are tailwinds there. And I just buy, and I just let time do its thing. And from Haas, the CPLie PE, when we look at 1929, it looks like a picnic. So really only the dot-com bubble were we this overvalued in regards to the CPLie PE ratio. And this is an interesting chart, the S&P earnings yield minus inflation. And when we look at the 73-74 period and the 1980 period, and then we look at 2000, 2007, and now. So what does this tell us? I believe this tells us that S&P earnings over the next decade are going to be flat at best or negative. So be careful in buying these high PE, low yielding stocks at the moment. Be very, very careful. Not financial advice. Be very careful. And in this article, the Sydney Morning Herald, days of QE numbered as Reserve Bank lets key interest rates climb. And so you thought the RBA would always come to the rescue of the housing market, huh? Sorry to have to tell you this. Not. But the RBA just capitulated to the stronger bond market. And that's right. That's what they've done. They have said that they are no longer going to support quantitative easing in buying these bonds. And so we've seen the bond market right across the yield curve absolutely spike. And we're going to have a look at that now. So this is not a cryptocurrency. This is not a SPAC. This is not a NFT. This is the Australian 2-year government bond, folks. That's right. The Australian 2-year government bond. Jonathan Payne from the Payne Report. To my Australian friends, it's time to sell your investment properties. The housing party is over. It's not often you see a 5-fold increase in 3-year bond yields in just over a month. And folks, these bond yields have actually gone higher than when Jonathan tweeted this out. So on Friday last week, this was the 1 year, the 3 year, the 5 year, and the 10-year Aussie bond yield. Absolutely skyrocketing. Now, you probably can't really see how much it's actually gone up by this. So let's actually have a look at some charts. So when we look at the Australian 52-week bill yield, you can see almost immediately it just skyrocketed straight up from 0.05% to over 0.3%. And the Australian 2-year note was below 0.1%. Then it rose to just over 0.1%, and then vertical to almost 0.7%. And the all-important 3-year, well, once again, that was around 0.1%. And then we had some shenanigans earlier in the year where there was some talk of, other central banks losing, or the RBA losing control of the yield, and then they went back in and purchased, and got it down to 0.2%, not to the 0.1%. But now, look at that. It's come back a little bit, but that hit almost 1.2%. We're at over 1.14%. So, this is going to be very interesting to watch and see what central banks do. And you can see the Australian 5-year as well. Once again, just almost on a vertical move there. And so the 10-year did touch 2%. It's come back down to 1.94%. And, the interesting thing is, what will central banks do? What will the RBA do? Will they allow the market to set interest rates? And how high will those interest rates, these yields, go? And what does that mean for banks, for mortgages, for business loans? Yeah, and in particular for Australia, because we've got huge household debt. And if interest rates do rise, according to the RBA modelling, 33% fall for every 1% increase in interest rates. So it seems like futures markets have already priced that in, that we are going to be in this time next year about 1% higher than where we are. And we are seeing a lot of people lock in fixed rates. We've seen the banks right across the board increasing their 3, 4, and 5 year fixed rates, and quite substantially. And they've done it multiple times over the last month or so. And so, what is this going to mean for debt, for the financial markets, as in the stock market and real estate market? Well, if central banks allow this to rise, as I said, even 1%, we're going to see some sell-offs in the stock market, in risk-on assets, and even the property market. We're going to see some interesting things happen there. Usually, that takes a little bit more time than, say, the stock market. This could then create a liquidity event, which will create demand for the US dollar, I believe. And you know, I am with the Peter Schiffs and that of the world, that fiat currencies are just, you know, toilet paper. Okay, I agree with that. But, you know, or do central banks go, no, we can't allow asset prices to collapse? And do they just turn on the so-called printing presses through quantitative easing, creating bank reserves, and just put more liquid into the financial system, more liquidity into the financial system, which ultimately I think will create more inflation, because we're going to see more fiscal driven demand. And Joseph Wang, the Fed guys, talked about that, and I recommend going and buying his book. Just Google Joseph Wang book. I think it's called Central Banking 101 from memory. Or go listen to some of his interviews on YouTube that he's been doing recently. Really smart guy. And he's saying, no, people have got this all wrong. Yes, there was an inflation after, you know, QE 1, 2, 3, and so forth. But what's happening now is different. And Professor Richard Werner also said back then that we weren't going to see the inflation that, say, the Peter Schiffs were talking about. But now he's saying that it's different. It is different, and it is different. But what I do see is a move to risk-off assets, to protection assets. And so, yes, we might see gold and silver fall off or sell off a little bit if there is a sell-off in financial markets as rates do rise. But ultimately, I think, like in March last year, there's going to be, and I've said this before, there's big financial institutions that have got a lot of cash sitting on the sidelines. And yes, they've had this risk on play to capitalize on this central bank liquidity into financial markets. And we've seen these risk on assets increase dramatically. And it's fantastic to be on that roller coaster, riding that up. However, they have told me that they have been taking profits off the table, sitting in cash, waiting to see, and they are now looking at the inflation story. And this is why central banks and bond yields are rising, is because of inflation. People are now waking up to that inflation trade. And so they are looking to see what happens, and they are ready to move back into gold and silver like they did in March last year, when they moved into gold and silver, when they were sold off, and you saw a lot of money come into that sector. And from the bottom in March right through to August, we saw gold hit its all-time high. We saw silver have a terrific run from $12 up to $30. Fantastic runs for gold and silver, and I think we are going to see that move soon. But anyway, that's my opinion. What do you guys think? Love to see your thoughts and opinions in the comments below. If you like this video, please hit that like button. If you haven't yet subscribed, do so and hit that notification bell. Take care, guys, and I'll see you again on another episode of Finance Uncut.